So, thinking differently and better, because on average, you will be average. And that's one of the challenges with investing, because markets are consensus thinking. They are averages of, a lot of information and a lot of intelligent people with effective tools making decisions. So in order to be successful, and we're defining success as being able to perform better than the market over a long-term period, how can you think differently, have a different idea, but also a better one? So we'll think about, what does it take to beat the averages, and what enables you to have an edge and a tool that will enable you, or a thought process, whatever combination there is, that will give you an investment edge that will enable you to perform better than the market. And of course, investing is predicting the future. So how is it that you'll have any kind of insight that the rest of the market doesn't have, and then have the fortitude to stick with that prediction? Because being different is also being uncomfortable, right? If there are a lot of smart people thinking one thing, but you're thinking something else, that can lead to some significant discomfort. So there are challenges with that. And of course, making predictions, sticking with those predictions, managing risk, understanding when it's time to change, all of that are an integral part of performing well. So when we think about beating the averages, so first of all, as we said, the market is consensus thinking, but consensus thinking isn't mob thinking, right? There are a lot of intelligent people with a lot of good information, very effective tools, and they're coming up with decisions. So what enables you as an investor to perform well in that kind of circumstance? Well, one of the things that I propose is to think in layers, right? There's a lot of superficial thinking, meaning the first layer of thinking. I mean, one of the things that I, confronted a while ago is someone had told me, well, the only thing you need to know in order to make an investment decision is what a company's growth rate is. And there are people who've done quite well investing over several years, investing only in high growth companies, right? But of course, that's one layer of thinking. Well, what about profitability? What about the capital expenditure required to maintain that growth? What about all of those other issues? Of course, there's a competitive environment. You may be growing at a high rate today, but can you sustain that? And how do you do those things? And those are different layers of thinking. And that's really what I'm getting at, is good thinking, first and foremost, requires layers. A deep thinking, deep understanding, and then an understanding of cause and effect within those layers. And it's essentially like artificial intelligence, where artificial intelligence enables you to have essentially dumb code to begin with, but then different layers of analysis and algorithms that process, think through, and then enable you the tools to think differently. And this is where this essentially comes from, an ability to look at what's happening, then understand a layer beneath that and a layer beneath that, where you can really get at effective, not only cause and effect, but also sustainability of those things, because that really informs your investment decision. So an edge. What we really want to think about is, well, what makes a difference, right? And one of the things that we have to make a distinction between is that which is influential and that which makes a difference. Makes a difference means it changes an investment decision, it changes a business decision. There are circumstances around which that there's a material impact on the value of your investment, right? And so what we talk about is there are conditions that are necessary, but it's a combination of those necessary conditions that create the sufficient condition that makes an investment decision, right? So you get at what matters. John Doerr, the venture capitalist, he very famously said, well, measure what matters. There are so many factors going on, but what's the thing that really matters and makes a difference? And this is where your insight comes into play, right? Where you look at, well, there is a complex set of circumstances going on. Let me understand that complexity, because there are too many simplistic models, and this is one of the advantages that you have if you really choose to think deeply, is that too many people take that road that says, well, we'll just look at growth rate. We'll just look at some EPS number. We'll just look at these very simple things, and that will get you the average if you're lucky, right? And really doing well means you understand a complexity and how there are certain circumstances that enable you to perform in a superior manner given those complexities. And then we'll get at what tools it takes to find those complexities, and they can vary, right? So investing is predicting the future. So how do we predict the future? Well, one of the things that I rail against is efficient market theory, Because efficient market theory simply says, well, we know everything that needs to be known, so all investors will then therefore make the same decision. Well, that's nonsense, right? Even if we know everything, people make different decisions with what information is available because you weight information differently. And this is where that layered thinking really takes hold, where I've got all this information, but I understand that matters more than this, and I understand those relationships better, and that enables me to make a better decision. And an example that I've used is an example of an efficient market is a chess game, right? So a chess game, everybody knows every possible move at all times. Nothing is hidden. All information is known. Yet good chess players win. Well, why is that? Because they see patterns, which means they understand things that are more important, moves that matter more, a more impactful move. As Bobby Fischer very famously did against Boris Spassky in 1972, when he sacrificed his bishop, he enabled a move that Spassky just didn't see. So he understood the algorithm and the depth that could lead to victory in that chess game. But it really gets to victory, as we call it, outperforming, where you understand with information that you have what really makes a difference, right? So, and you also understand there are things that influence things that make a difference. And then, of course, that's dynamic. Maybe going back to our chess game example, well, people make moves, and sometimes they make moves that are shocking. Again, when Garry Kasparov played the IBM Big Blue, right? He lost one match because Big Blue basically had a glitch in its program, and it made an absurd move. Now, Kasparov, being a chess master, was saying, well, that no one makes an absurd move. Why did he do that? And it threw him off completely. And he later talked about that it was just such an aberrant move that he couldn't make sense of it. And so understanding dynamics and what matters, what's changed, what's really going on, this is a critical component to think about investing strategy, right? And so we talk about variations and commonalities. What I mean is there are different ways to do very well. So we talked about an investment edge, we talked about outperforming. So let's take some examples. So Warren Buffett basically uses his discretion. He analyzes, he makes singular choices, he goes through the analysis, and he makes his choices, with his partners, of course, but makes his choices given market conditions, etc. But compare that with James Simons, who very successfully has developed these algorithms that determine investment choices. So what that approach is, I understand what matters, I understand the dynamics, I understand what's important. I've laid out algorithms that basically do that thinking for me, and they are much more effective. So I don't have the human error that can be involved with discretion. So, Warren Buffett very famously said, well, I really believed in what Jeff Bezos was doing at Amazon, but I basically just couldn't make that move, right? And whatever reasons, he lost out on a significant gain. Well, an algorithm won't have that emotional attachment. And so Simons has done extremely well taking, if you will, the human discretion, or the algorithm gives an answer. You do that work beforehand, but you trust the model. And then in between that is D.E. Shaw. That also has been extremely successful. Now they're based on data science and thorough work and all this analysis, but they also leave room for discretion as well, because they'll say if we see a unique opportunity, we will just make the choice to follow it. So that's a hybrid, if you will. So each of those models, while very different, has worked extremely well. Each of those firms has produced more than 20% annual returns. In the case of Simons, of course, before fees, a 60% annual return for 30 years, which is just extraordinary. And of course, maybe that speaks to real discipline, real effective algorithms, understanding and trusting the model. Maybe that leads to the best outcomes. Of course, it could just mean Simons and his team have truly unique opportunities and abilities, but there's still something about the discipline that real information and data science will provide for you. So, as I mentioned before, being different is being uncomfortable, right? And one of the things that you have to make these choices because you have to be willing to be wrong. Maybe in the case of Amazon, not to pile on to Warren Buffett, but he was unwilling to be wrong about Amazon, right? Well, you have to be willing to be wrong because guess what? If you're an extraordinary investor, you're going to be right only a little bit more than you are wrong, right? And so you're going to be uncomfortable, you're going to make some choices, but it's that discomfort that will lead to decisions that on balance will be better and you will outperform the market. And I call it, being almost mostly right, which means being just a little bit more right than wrong. And all these great investors will say, well, maybe we're right 51% of the time, 55% of the time. Nobody is right more than 60% of the time if they're really in the market for a long time. And that's the point. The point is, be willing to be wrong, because when you are, you will probably get more decisions right, and those decisions will have extraordinary payoffs. And very famously, James Simons has said, we're right 50.75% of the time. But 50.75% of the time, we're absolutely right. So they know when to make those commitments. And so also understanding the market changes, there are great dynamics. You have to deal with those dynamics. There is no such thing as a static model. Whatever your approach is, whether it's true discretion, whether it's a hybrid, or whether it's all algorithmic, things change. There are dynamics, and you have to understand that. And then we have, predictions and risk. Now, one of the things that we want to talk about is that a strategy that is independent of the market, right? So the market has its volatility. So a strategy, let's just say you own a stock that pays a steady dividend regardless of the market price, regardless of market conditions. That dividend just doesn't change. Well, you're essentially independent of the market, right? So you'll get that return, you'll get that steady cash flow, and whatever the market price is, you don't care because you're not selling. You're not in this for the capital gain. You're in it for the return. So that one security has given you independence from the market. Now, that assumes that that company is still able to pay their dividend, and that's an analysis that one needs to do. But if you are able to then be independent of the market, but also profit from volatility, right? And that's where Simons and D.E. Shaw really come in. Their algorithms say, well, whether the market is up or down, when we have liquidity, we can trade and we can profit in either direction. And that's the most effective strategy, because you will have risk and you will have unpredictability. So one of the challenges is an investment strategy is not an investment company. A company focuses and manages risk. A company understands how to be sustainable. A company has a long-term perspective. An investment strategy is, well, maybe I can make some money this year, next year, maybe even the year after, but that's not sustainable. And we've got great examples of that. I call them kind of the hyper-glory people who show up on CNBC because they did extremely well this year or last year or whatever, but that's not sustainable, right? So, we've got these people who said, well, growth is all that matters. And for 3 years, you did extremely well because market momentum carried you along. So you levered your portfolio. You had high market momentum that went along with that. You did extraordinarily well. The market turned, you were wiped out, right? So there's several examples of investment funds where that's been the case, right? So real risk management will always avoid that. You would never expose your portfolio to the point where if it goes the wrong way, you're wiped out. It's one thing to be wrong. It's another thing to risk so much that when you're wrong, you're out of business, right? But that's what these companies do because they have this kind of hyper-glory media star approach to investing, and it turns very quickly. And that's not an approach to be a long-term investor. That's not thinking differently and better, right? So as we mentioned, being slightly better makes all the difference, right? If you're James Simons and you're winning 50.75% of the time, but you produce the highest returns of any other investor, well, that says a lot, right? It says that being slightly better can make all the difference. And having layered thinking, having these proper investment tools, trusting those tools, being dynamic, understanding that the market changes, understanding conditions change, all of that can lead to a far superior performance with a slightly better edge. And that's what it takes, right? So in summary, what we're saying is, beating the averages is no small trick, right? Because the averages are really created by people who have great tools. They're very intelligent, very experienced, and these men and women know what they're doing. So now you've got to do something that's different. So how can you do something that's different? Well, you create an edge. Well, easy to say, hard to do, but it takes layered thinking. It takes layered thinking about real complexity, understanding what really matters, understanding those factors, being disciplined about those factors with real rigor and understanding, and then that enables you to predict a future where you're a little bit better, and you have to deal with your discomfort because you'll think differently and you'll lose. And then you'll think differently and you'll win, and then you're thinking differently again, and that makes you uncomfortable whether you'll win or lose, right? So there's a lot less certainty to that. One of the reasons why index funds are so popular is you don't have to think, right? Okay, whatever the market does, it does. It's the S&P 500. I can just go home now, right? Well, okay, that's fine, right? And you will be among the averages. But if you want to have an investment company that manages risk and is sustainable, that also means thinking differently and managing your discomfort when you do that. Making those predictions, understanding and managing risk, and being a real business. That's the key.